Hello and welcome! Today, we're diving into something super powerful, something that often gets ignored, but if you're an investor or an entrepreneur, you absolutely have to know about it. I'm talking about the cash flow statement. Seriously, forget the flashy headlines. This is where the real truth is hiding. So let's get into it.
Okay, so let me just throw this out there right at the start. Picture this. You've got a company, right? The annual report looks amazing. They're posting millions, maybe even tens of millions of profit. Now, could that same company actually be on the brink of going bankrupt? I mean, really, think about it. Is that even possible?
Well, the answer, and this is what blows people's minds, is a huge yes. It absolutely can. And you know what? It happens way more than you'd think. Figuring out why that is, well, that's the secret to not just protecting your money, but to really truly getting what makes a business tick. And here's why. It all boils down to one simple, massive difference. See, that profit you see on paper, that's really just an opinion, an accountant's opinion to be precise. It's based on all these rules and estimates and when they decide to book things. But cash? Cash is different. Cash is a cold, hard fact. It's the actual money that hits the bank account. It's what pays the rent, what pays your employees. It's what keeps the lights. So, let's dive into this first part, what I like to call the profit lie. We're going to really break down how a company can look so good on the surface while its foundation is crumbling. In this quote, man, it just says it all. You can have a company showing millions in profit, but secretly, it's just burning through cash and heading straight for disaster. This is a classic trap for investors, by the way. They see the big profit numbers, maybe a cheap stock price, and they think, wow, what a bargain, only to find out the company is basically running on fumes. Okay, so if profit can be this illusion, what's our reality check? What's the solution? Well, this is where our hero comes in, the cash flow statement. Seriously, you should think of this thing as your own personal detective kit. It's the ultimate truth detector. So what is this thing really? It's simple. It's just a report that shows you where the actual cash went. Money in, money out. That's it. It cuts through all the noise, all the accounting tricks, the weird non-cash expenses like depreciation, where they write down the value of a machine but no money actually leaves the bank. Yeah, this statement ignores all that. It's just the pure, raw story of cash.
Now, to really use this tool, you got to know it's not just one big number at the bottom. It's actually telling you three different stories. Three little chapters that, when you put them together, give you the whole picture. It's by looking at these three stories that we can start to see what a company is really up to.
So what are they? You've got operating activities, investing activities, and financing activities. Each one is a critical piece of the puzzle. Let's break them down one by one.
Okay, first up, and honestly, this is the big one, operating activities. This tells you if the company's core business, the thing it's supposed to do, is actually making any cash. Are they bringing in more money selling their stuff than it costs to make and sell it? This is the lifeblood. You have to see positive cash here over time, or you've got a serious problem.
Next up, number 2, investing activities. This is all about where the company's putting its cash to grow for the future. Are they buying new buildings, upgrading their tech, maybe even buying a smaller competitor? And here's a little secret. A negative number here can actually be a great thing. It means they're investing in themselves, planting seeds for future growth. And the third story is financing activities. This is all about how the company gets its money from outsiders. Did they take out a big loan from a bank? Did they sell new shares of stock to investors? Or maybe they're paying back a loan. This part of the story shows you if they're funding themselves or if they're relying on banks and investors to stay in the game. Okay, let's look at an example so this isn't so abstract. Check this out. It's for an education company. See how the three stories come together? First, operating cash is positive. Awesome! That means their main business is making money. Second, investing cash is negative. Also great. They're spending that money on things like new equipment to grow. And third, financing cash is positive, which means they took on a little extra funding to help pay for all that growth. You see that pattern? That's a textbook sign of a healthy, growing company. All right, so we've got the basics down. Now for the fun part, the real detective work. We're going looking for the red flags, the smoking guns, the little clues that tell you something is seriously wrong with the company. And this right here, this is one of the biggest red flags you'll ever see.
Look at this. On the left, you have that nice big green bar. That's the profit they're telling everyone about. Looks great, right? But then, look at the red bar on the right. That's the cash from their actual operations. It's negative. They're losing money. When you see these two going in opposite directions, you have to ask yourself, where on earth did that profit actually go?
Which brings us to red flag number 1, consistently negative operating cash. If you see this year after year, it's a huge alarm bell. It means their main business is just a bonfire for cash. I don't care what the profit number says. You can't pay your bills with an opinion. You need real cash. This is probably the biggest warning sign of them all.
Okay, red flag number 2. The company is totally dependent on financing. What does that look like? It's when you see them constantly taking out new loans or selling more stock. But not for exciting new projects. No, they're doing it just to cover their day-to-day losses. It's exactly like living off your credit cards, paying one off with another one. You and I know that game doesn't last forever.
And for red flag number 3, this one is a real sign of desperation. The company starts selling off its assets. Not old stuff, but the very things it needs to operate, just to pay today's bills. They're literally selling the furniture to pay the rent. They're selling their future to survive the present. And eventually, well, they'll run out of things to sell.
So, how do you take all this and actually use it? Don't worry, we've boiled it down into a simple checklist you can use for any company you look at. This is your game plan.
It's just 5 simple questions, 5 steps. 1. Always start with operating cash. Is the main business making money? 2. Compare that cash number to the profit number. Are they telling the same story? 3. Don't just look at 1 year. Look at the trend over, say, 5 years. Is it getting better or worse? 4. Check out what they're doing with their investing cash. Are they planting seeds for the future? And finally, 5. Look at their financing. Are they raising money for smart growth or just to stay alive?
Look, if you remember only one single thing from our time together today, make it this. It should be your mantra. Profit is opinion. Cash is fact. Let other people get fooled by the pretty numbers on the income statement. You'll know better. You'll be looking at the cold, hard cash.
So here's the bottom line. You now have the truth detector. You have the skills to cut through the noise, to look past the hype, and to see what's really going on inside any business. So my only question for you is, now that you have it, what are you going to go investigate first?